Some businesses make a lot of money, but when it comes to selling, they're almost impossible to move. Other businesses sell fast at a premium with multiple buyers competing for the deal. The difference doesn't always come down to financial performance, it's simply how well the seller has prepared the business to transfer to a new owner. In this video, I'm going to walk you through 5 things that you need to do to prepare your business for sale and get the most possible value out of the transaction. I'm James Beatty. I'm a senior sell-side M&A advisor at Empire Flippers, and I've personally helped over 80 online business owners successfully exit their business. I've sat in on over 100 deals that went through due diligence. Some of them went extremely smoothly and closed exactly as expected, whereas others went drastically wrong when the covers were pulled back. So let's get into it. Here are the 5 things that every serious buyer evaluates when considering an offer or going through due diligence, and what you need to do about each one. This is what I call the transfer task. Number 1 is financial clarity. This is the one that kills the most deals. Not low revenue, not a bad niche, but simply messy books. Here's what happens in every transaction. A buyer gets interested, they'll look at your initial P&L, they potentially place an offer, and then they start verifying the numbers in due diligence. They might pull up your Seller Central data, your Stripe dashboard, your bank statements, and they check whether everything lines up. If it does, confidence goes up. If it doesn't, they don't think, oh, this seller is just bad at bookkeeping. They think, what else is wrong that I can't see? And that doubt either kills the deal or shows up as a significantly lower offer or renegotiation, because at that point, the buyer has all the leverage. So here's what clean financials actually means. First, separate your businesses. If you're running multiple businesses or side projects, those need to be completely separated in your books. Separate bank accounts, separate P&Ls, separate everything. When a buyer looks at your financials, they should see one business clearly, not a tangled web of entities that they need to untangle. Now, in the online space, we understand that a lot of sellers run multiple projects under one entity. In our vetting process at Empire Flippers, we help prepare a P&L solely for the assets that are for sale. But when it comes to due diligence, buyers will still want to verify those numbers through your bookkeeping software or bank statements. You should be able to easily carve out the business unit being sold and back up which expenses actually relate to that brand. I had a great business come to market that fell through with multiple buyers because the seller was running a second business through the same entity. Nothing wrong with that in principle, but everything was commingled, right down to the supplier. He was ordering inventory for both brands from the same supplier, which made it extremely hard for buyers to verify which expenses related to which business. They simply lost trust during due diligence, not because the business was bad, but because the financials were messy. Second, your Seller Central revenue should match your bookkeeping software, which should match your bank deposits. Your ad spend in the ad platform should match what shows on your P&L. If there's a gap anywhere, figure out why before a buyer finds it for you. Third, stop running personal expenses through the business. I know your accountant told you to write off your car and your home office and your family phone plan, and that's fine for taxes, but every personal expense on your P&L, it becomes a question mark during due diligence. As a broker, yes, we can add those back, but add backs are just question marks with explanations attached. And question marks, they cost you money. Some add backs are cut and dry. It's hard for a buyer to argue with them, but others are much more subjective and up for debate. The fewer add backs, the better. If you know that you're selling in the next 12 months, try and pull every personal expense out of the business now. Let your trailing 12 months tell the story without needing adjustments. Fourth, get a real P&L in place, not just a spreadsheet that you threw together last week. It should be a clean, organized profit and loss statement going back at least 12 months, ideally 24. At Empire Flippers, our vetting team builds out your P&L as part of the listing process. For businesses on Amazon or Shopify, we actually pull those numbers directly through the platform APIs, so the revenue on your P&L matches exactly what shows in Seller Central or your Shopify dashboard. There's really no room for discrepancy because it's coming from the same source. Where it gets more complex is if you have income outside of those platforms. Wholesale, a direct-to-consumer channel, affiliate revenue, that's where your own bookkeeping needs to be tight, because we can't pull those numbers automatically. And if you're running personal expenses through the business, have a clear documentation and rationale for each one. Business travel to a supplier meeting in China is fine. A random 3,000 charge with no explanation is not. That's not going to be treated as an add back. I've seen sellers with genuinely good businesses lose tens of thousands of dollars because they couldn't produce clean financials on request. And any serious buyer in this range is going to ask for it. The thing is, these numbers were real. They just couldn't prove it quickly. And in this market, buyers have options. They'll simply move on to the next listing that doesn't make them dig and do homework on the business. Number 2 is SBA financing readiness. This might be the single most impactful thing you can do for your exit. And it's one that almost nobody prepares for. Most buyers in the 500K to 5 million range want to use an SBA loan. It allows a buyer to put down 10 to 20% instead of paying all cash. That means that a buyer who has $200,000 in capital can now purchase a $1 million business. Think about what that does to your buyer pool. Instead of only attracting people who can write $1 million check, which is a very small group, you're now accessible to experienced operators who have $150,000 to $200,000 to put down and strong enough financials to qualify for a loan. That's a dramatically larger pool of qualified buyers. And more buyers means more competition. More competition means better offers. It's simple supply and demand. If your business doesn't qualify for SBA financing, you've just eliminated a large portion of serious buyers in this range. And you're left with all cash buyers only, and they know that they have less competition, which means they have leverage. So what does SBA eligible actually look like? Here's what a lender actually needs to see. Clean financials that match your tax returns are non-negotiable. The SBA lender is going to compare your P&L to the tax returns, and they need to align. If your CPA made adjustments that don't show up in your internal books, fix that discrepancy now. If there's a gap, you need to be able to explain it and bridge it. But any unexplained gap drastically reduces your chances of being eligible. The business must also support debt service. The buyer is taking on a loan, and the business has to generate enough cash flow to cover the loan payments and still leave the buyer with a reasonable income. Razor thin margins can be a problem here. You'll also need at least 2 to 3 years of tax returns. Lenders want to see history. If you've only been in business for 18 months, SBA is going to be difficult. 2 years is really the bare minimum, ideally 3. And one practical note, the business needs to be based in the US. Non-US businesses are not eligible for SBA financing. Finally, the business needs to run without you. This ties directly into the next point, but if a lender sees that the business completely depends on the current owner, they view that as a risk to the loan. Because if the business falls apart after the sale, the loan goes bad. I've seen deals where the only difference between a bidding war and a single lowball offer was whether the business qualified for SBA or not. It really is that significant, so if you are eligible, you should try your best to prepare your books to get that loan. And the irony is that most of the requirements, clean books, documented operations, a business that runs independently, are things that you should be doing anyway when preparing for a sale. Number 3 is operational independence. A buyer is purchasing the business, not hiring you. The more it depends on you personally, the harder it is to transfer and the riskier it is for the buyer. Owner dependency can make or break a deal, especially in the 7-figure range. There are 3 layers to this, and you need to address all of them. Layer 1 is get out of the day-to-day operations. Buyers in the 6 and 7-figure range are not buying themselves a job. They're buying an asset. If you're the one processing orders, answering customer emails, managing ad campaigns, and negotiating with suppliers, you are the business. And that's a problem. Your goal is to be focused on high leverage tasks only. Brand direction, product development, strategic decisions. Everything else should be handled by your team. Even 1 or 2 virtual assistants handling the day-to-day fundamentally changes the transfer story. Layer 2 is documenting everything. Standard operating procedures for every recurring task. Order processing, customer service, ad management, supplier relations, content creation, monthly bookkeeping. Write it down step by step, as if you're training someone who's never seen the business before, because that's exactly what a buyer is. Here's the fastest way to do it. Record yourself doing each task on Loom or a screen recorder, then have a VA or even AI now transcribe that into a step-by-step document. Test it by having someone else follow the SOP without your help. If they can do it, it works. If they can't, refine it until it does. Layer 3 is solve the face of the brand problem. This is the hardest form of owner dependency, and it catches a lot of content and e-commerce founders off guard. If you're the face of the brand, if you're the one on camera, if customers know you by name, if you're instrumental in sales or marketing, that is going to reduce your multiple. A buyer looks at that and thinks, what happens to this brand when this person leaves? If you're 12 months out from selling, start transitioning now. Shift from personal brand to company brand. Build a content team that creates without you. If you have a YouTube channel or social presence tied to your name, start introducing team members or pivoting to brand-led content. You may not be able to fully remove yourself, but you need to show a buyer a credible transition plan. Here's how this business works without me. That's worth real money. Number 4 is concentration risk. Every buyer is doing a mental risk assessment. The question that they're asking is, if one thing goes wrong, does the whole business collapse? There are 3 types of concentration that buyers worry about. One is revenue concentration. If 40% or more of your revenue comes from a single client or 70% comes from a single product or SKU, that's a red flag. There are cases where a single SKU brand can be de-risked and otherwise, but in most cases, you want some form of revenue diversification. Launching 2 or 3 more complementary products doesn't just grow the business, it makes it a fundamentally safer asset to buy. Number 2 is traffic concentration. If all your traffic comes from one source, Google, Facebook, Amazon's algorithm, you're one algorithm update away from serious trouble. I've seen this play out firsthand working in the content space. Google changed their algorithm and businesses that have been running for years simply disappeared overnight. Buyers know this, so build an email list. That's an owned audience that's independent of any algorithm. Test a second traffic channel. You don't need to master it, but if it's picking up a portion of the traffic, that helps. You don't need to master it, you just need to prove that it works. Number 3 is platform concentration. If you're 100% Amazon, 100% Shopify, or 100% dependent on any single platform, you're exposed to fee changes, policy changes, or account suspensions that are completely outside of your control. Even a small presence on a second platform signals reduced risk to a buyer. Now, none of these are overnight fixes, but that's why you start as soon as you can. Each step that you take reduces a buyer's perceived risk, and reduced risk means a higher multiple. Number 5 is structural readiness. This is the one that catches sellers off guard during due diligence, not because there are problems, but because they never formalized the basics. Trademarks. If you have a brand, make sure it's trademarked. A registered trademark is a tangible asset that transfers with the business, whereas an unregistered brand name is simply just a word on a website. It costs a few $100s and takes a few months. So do it now. Get that in place before you sell. Contracts and agreements. If you have VAs, contracts, suppliers, freelancers, get those relationships documented. Even simple agreements are better than handshake deals. A buyer wants to know that the team will stay, the suppliers will keep supplying, and the key relationships will survive the transition. Organize a deal room. Get all your documents, financials, SOPs, contracts, analytics access, supplier agreements organized in a single place before you go to market. I'd recommend something simple like Google Drive, and having this ready signals professionalism and it massively speeds up the process. So when should you actually start preparing for this? Well, as soon as possible, ideally 6 to 12 months before you want to sell. But for online businesses, a lot of these changes can be made faster than you might think. Cleaning up financials takes months of clean trailing data, so get that started as soon as possible. Getting SBI ready means that your P&L needs to match tax returns. Reducing owner dependency means hiring, training, documenting. Diversifying concentration risk means launching new products and building new channels. None of that's going to happen in 2 weeks, but the sellers who achieve premium multiples give themselves runway. They start early, preparing while the business is healthy, and they make systematic improvements. And by the time they go to market, usually the business is better because these things just improve the business in general, and they're bulletproof in due diligence. And finally, don't swing for the fences right before selling. I see this a lot, and a seller decides to exit and thinks, let me launch 5 new products, test 3 new ad channels, push revenue as high as possible before I list. In practice, it usually backfires. New launches fail, profitability goes down, new channels take time to optimize. And if those experiments hurt your margins or create a revenue dip, you've just made your trailing 12 months look even worse, not better, and it adds concerns and questions for a buyer. The best time to list is when the business is doing what it does well, consistently. Steady beats spiky, so play the game that you've been winning at and improve that as much as possible. So let me bring all this together. The transfer test is 5 things: financial clarity, clean books, numbers that match everywhere, SBI readiness, a P&L that matches your tax returns, cash flow that supports debt service, and at least 2 to 3 years of history. Operational independence, SOPs that are documented, a team in place, and you focused on strategy not operations. Concentration risk. No single product, client, traffic source, or platform that could collapse the business on its own. Structural readiness. Trademarks filed, contracts in place, deal room organized before you go to market. Every item on that list, it moves your multiple. And at the deal sizes we're talking about, every increase in multiple is worth tens or hundreds of thousands of dollars. The sellers who pass the transfer test attract more buyers, create more competition on their deal, and close faster at higher prices. The sellers who don't, they struggle in due diligence. They get initial offers negotiated down and they'll lose deals that they should have closed. So if you're watching this and you're thinking that you want to start getting your business ready, that's exactly the right instinct. If you're doing over 25K a month in net profit, I'd love to work with you directly. You can schedule a free consultation with me in the link below. If you're doing under 25K a month, you can also get a free valuation on the Empire Flipper site. It only takes a few minutes and it'll give you a rough idea of what your valuation could be, and you'll be able to work with our team to sell your business. Even if selling is 12 months away, the earlier that you start, the better your outcome. Some of the best exits that I've worked on started with a seller who reached out early. They spent 6 to 12 months working through these points that we've discussed, and then they went to the market in the best possible shape. In the next video, I'm going to cover what actually happens when you go to market. The selling process from listing to close and what to expect at each stage between them, and how to navigate negotiations to get the best deal possible. So subscribe so you don't miss it.